what odds would you give, or how much would you be willing to bet on this parlay of three things all lining up to really pay off?
I'd put all my chips in the center of the table on this one. I think it's going to be a decent year. May not be 2023, but, the fourth year presidential cycle, the fact that I believe the Fed will be cutting interest rates by April, May, I think money will come off the sidelines. $8.8 trillion is a lot of cash. And if rates come down just a little bit and you get a portion of that coming into the equity markets, you're fine. And as for the rest of the world, the U.S., even by default, looks better. So that's where you'd put your money.
If rates come down a little bit, do you think that that's enough movement then to persuade people who are enjoying whatever you're getting in your CD or your money market fund or the safety zone? Is it enough to get them to move their money into slightly riskier investments?
Yeah, I mean, what was it? Total return on the S&P 500 last year was 26%. So that's a 21 percentage point differential. I think ultimately, look, it doesn't happen all in one push, and it'll take some time.
And we hear this a lot.
Yeah.
I mean, this is the constant clarion call of the bulls, that there's money on the sidelines that's going to flood the market. It's going to take things up. And I'm not sure I buy that narrative.
Well, I'm not sure looking for a flood either. I mean, if you just get an 8 to 10%.
Yeah, you did say, a little bit, marginal.
Brian, what about you? Do you think that this money on the sidelines is just burning a hole in people's pockets and they're ready to go buy stocks?
No, I don't think so. I think actually what we're seeing is that a lot of the quote unquote money on the sidelines, it never really comes off the sidelines. As people try to reallocate their portfolios, for every buyer, there's a seller. So it goes off the sideline, but then goes back onto it. And will sentiment improve? I think that's really the key thing, because the money is still going to sit there in some form or another. And when you look at the dynamics behind what has gone into money market funds, it's really come out of savings. And so I think for a lot of people, this just represents a reallocation of what economists would call their precautionary savings. So it's not necessarily something that they have earmarked for more speculative or long-term purposes. It's more about for your rainy day fund. And really, when you look at the total amount in checking accounts, savings accounts, and money market accounts, it's at about 10.4% of household assets. That is the historical median. So I don't think people are over allocated to cash by any stretch of the imagination here.
Want to react, Ron?
Well, I mean, they're over-allocated if they want to get better returns than they're getting in their money for cash. Yeah. And I think it doesn't take all $8.8 trillion to move, right? I mean, it doesn't have to be that much. And again, they're not the only buyers in the game. There are professionals, there are, wealth advisors, a whole host of individuals who make allocations towards equities. And again, when I think you look at the U.S., you look at the fact that I'm 100% certain the Fed's going to start cutting rates, even just to get monetary policy closer to neutral. We don't need a recession. Mm-hmm. We don't need, some sort of calamity to get the Fed to move. And I think under those circumstances, the market has a tailwind rather than the headwind that we saw, at least coming into 2023.